Good day, traders. Today we're going to speak about Japanese candlesticks. I'll be doing some theory on Japanese candlesticks. We'll be looking into the history of Japanese candlesticks, an introduction to Japanese candlesticks, candlestick anatomy, candlestick patterns, and we'll look into candlestick myth, true or false. So Japanese candlesticks were invented by Manehisa Homa in the 17th century. Manehisa Homa was a rice trader who used candlestick patterns to trade and earn over $10 billion in trading, making him one of the best traders of his time. He was well respected to the point of being promoted to samurai status. Japanese candlesticks were introduced to the Western world in the 1980s by Steve Neeson from the New York Stock Exchange and Michael Feeney from the UK, when there was a large cross-pollination of banks and financial institutions around the world. Introduction to candlesticks. Candlestick patterns help to read price action better when trading naked. The only thing you see on the charts is candlesticks, nothing else. When you have to read anything, you need to first learn the alphabets, then the words, then how to put together a sentence, then a paragraph, then a chapter, then a book, which is what I saw when looking at a chart. So I had to understand the APCs of a chart. This is why I was interested in understanding the anatomy of candlesticks. Candlesticks are important to your trading analysis because they are visual representation of price action. We get valuable information about the open, high, low, and close of price. This all adds to us being able to understand price action, knowing what price is doing. It is a critical skill to have the ability to read price action and market structure. This allows you to use the right price action strategies for the right market condition. You have to be able to understand price behavior during different market conditions. Looking at market structure will help you identify if the market is in an uptrend, downtrend, or consolidation range. As a price action trader, you would use top-down analysis to identify what the market is doing or the market condition. Candlestick patterns come in at a later stage as an entry signal or further confirmation for other existing technical trading confluence factors. Candlesticks are also used by most professional traders, banks, hedge funds, large institutions across the globe, trading millions of dollars every day in the market. These are the people that move the market whenever they want. As retail traders, we can't move the market as we do not have control over what will happen in the market. We can only speculate. Using candlesticks help us see what the big boys are doing, where they might also look for entries and confirmations to enter trades, also exit triggers, and most importantly, when to stay out of the market and protect your capital. Remember, price action is king. Do not get too excited when you see these patterns, then think you trade them on their own without further confluence factors. The market moves based on the laws of supply and demand, not due to candlestick patterns. Candlestick patterns should be used with other technical factors like support and resistance, trend lines, Fibonacci, moving averages, and other trading techniques we have learned in previous mentorships or some that we are still going to learn in the next coming mentorships. So, the anatomy of Japanese candlesticks. The anatomy is how the candlestick is formed. This will help you see where price opened, made its high, low, then where price closed. As technical traders, we use candlesticks to read price action and determine these factors. A bullish candlestick pattern will open, make its low, make its high, and then close. A bearish candlestick pattern or bearish candlestick will open, make its high, make its low, and then close. Bullish candlesticks signify price closing higher, while bearish candlesticks are a sign of price closing lower. That's how we can differentiate between the two. Looking at some candlestick patterns. These are neutral candlestick patterns. The first one is a doji. The doji has an upper and lower shadow wick with little to no real body. Price closed close to where price opened, meaning neither bears nor bulls have the upper hand. The name doji means unskillfully made. It is a sign of indecision in the market. And then we look at a spinning top. Spinning tops have small body that is centered between the wicks. Same as the doji, it is a sign of indecision and a sign for you to stay out of the market until you have a true direction. Let's look at bullish candlestick patterns. I'll start with the single candlestick patterns. These patterns are formed by one candlestick. The first one is a hammer, named the hammer because it looks like a hammer. Body is on the upper third of the candle. The wick is twice the size of the candle, showing rejection of low prices. Price closed high. So at some point, there were bears coming in, and then the bulls came in and formed this hammer pattern, signifying bulls in the market. Inverted hammer, similar to the hammer, but upside down the other way around. Dragonfly doji. The pattern resembles a dragonfly. Usually dragonflies appear after a storm or rainy day. After price has dropped, the high, open and close are at the top third of the candle. Price closed high and rejected lower prices. These are more significant when found at a support area. Let's look at double candlestick patterns. These are formed when two candlesticks are found at a support level. The first one is a bullish engulfing. The body of the bullish candlestick engulfs the body of the bearish candlestick, meaning bulls have the upper hand. And then the second one is a piercing line, similar to the bullish engulfing pattern, except the bulls do not engulf the bearish candle. They only pierce above half the bearish candlestick, as you can see here. The close is above the midpoint of the bearish candlestick, signaling bullish pressure and loss of bearish momentum. These are bullish triple candlestick patterns. These are formed by three candlesticks simultaneously. The first one you have is a morning star, consists of three candlesticks, as I've mentioned. Bearish candlestick, indecision, then bullish candlestick. The morning is associated with the waking up of price, the rise of the sun, and the end of darkness. Bulls have won the indecision battle, and now prices may rise. As you can see in the middle there, that's a little spinning top, or you can call it a doji. Morning doji star. Morning doji star is just a variation of the morning star. However, you can see that on this, in the middle here, we have a doji where the price opened and closed in the same area, signifying indecision, and then the bears coming in to decide on the direction. The next one is three white soldiers. This consists of three consecutive bullish candlesticks. Price is making higher highs and higher lows, signaling bullish strength. You would associate soldiers with being defenders of a nation. In this instance, the soldiers are defending prices from dropping or crashing. As you can see, each green candlestick is higher than the previous one. Let's look at bearish single candlestick patterns. The first one we have is a shooting star. Named the shooting star because it signals price falling. Shooting stars normally shoot downward from the horizon. It has a long upper wick, small body. On the lower third of the candle, price closes lower and it rejects higher prices. Hanging man looks like a hammer, however found at resistance, and price closes lower instead of higher. The name hanging man is associated with death. Gravestone doji, also associated with death or a tombstone, showing the death of bullish momentum. It is the opposite of a dragonfly doji. The open, low, and close are at the lower third of the candle. And then we look at double candlestick patterns, bearish candlestick patterns. These are formed by two consistent consecutive candlesticks. The first one is bearish engulfing. This is the opposite of a bullish engulfing. The body of the bearish candlestick engulfs the body of the bullish candlestick, meaning bears have the upper hand. The second one is called dark cloud cover. Once you see dark clouds in the sky, it signals rain about to come or darkness. We associate this with bulls losing momentum and bearish pressure. The close is below the midpoint of the bullish candlestick, signaling bearish pressure and loss of bullish momentum. Now we look at bearish triple candlestick patterns. Consists of 3 candlesticks. The first one is an evening star. You have a bullish candlestick, so price was at some point moving upward. And then we have an indecision candlestick in the middle, then a bearish candlestick. The evening star on nights, the evening or night is associated with the darkness and the end of light. Dying of price, bears have won the indecision battle and now prices may drop. Evening doji star, just a variation of the evening star, where we have a bullish candlestick, so prices were moving up at some point, and then we had indecision, then a bearish candlestick followed. The last one is called 3 black crows, consists of 3 consecutive bearish candlesticks. Price is making lower lows and lower highs, signaling bearish strength. You would associate black crows with bad luck or bad things about to happen, meaning price is about to drop. As you can see here, the candlestick are forming lower lows, closing and opening lower than the previous candles. Bearish candlestick patterns are found mostly at resistance areas. Now, let's look at candlestick myths, or true or false about candlesticks. So some people think candlesticks can predict what the markets will do. However, this is incorrect, as candlesticks are a representation of what price has already done. It only shows the anatomy of price, which would be the high, low, open, and closing prices. It is best to rely on trend and market structure. The second myth is trading candlestick patterns is trading price action. This is incorrect, as trading price action is looking at market structure, trend, and other market conditions. Price action is a way of analyzing the overall market and finding the right strategy to trade the market. Candlesticks are a subsection of price action. They can be used as an additional confluence factor or entry confirmation. The third myth is candlesticks are a leading indicator. Candlesticks are not a leading indicator. They show what has already happened. If it has already happened, then it is in the past. Candlesticks have less lag than other indicators like moving averages, RSI, stochastics, and the likes. Leading indicators are support and resistance areas, Fibonacci retracements, stock markets, and fundamental news. Closing remarks regarding Japanese candlesticks. Always use proper risk management when trading. Always practice low risk for higher reward trades. If your risk is equal to your reward when trying to take a trade based on a candlestick pattern, rather miss the trade and protect your capital than to regret taking the candlestick indicator. Set hard targets of at least 1 to 2 risk to reward ratio, only risking 2% of your capital. Follow your trading plan, keep strict money management rules, be disciplined and patient with the process. Thank you.